Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
In this AI-generated podcast, learn how to build lasting wealth through strategic investments. Discover proven principles, smart asset allocation strategies, and long-term thinking that can help you grow and preserve wealth across generations.
Okay, so you're here because you want to get past the headlines, right? You want to really understand how strategic investing can build wealth that actually lasts.
Yeah, forget wading through tons of jargon.
Exactly. This is about getting straight to the core stuff. Today, we're digging into building lasting wealth with strategic investments. And our mission really is just to pull out the absolute key takeaways for you, the things you need for a clear, usable understanding of strategic investing.
You ever look at people who seem to build wealth consistently and wonder, how they do it?
All the time. And strategic investing often seems to be a big piece of that puzzle.
It really is. So let's start with the foundations, the bedrock ideas.
That's good. Where do we begin?
Well, the source first just defines investment itself, basically putting capital somewhere, hoping for future returns. Simple enough.
Right.
But the strategic part, that's about the long view. It's about focusing on growth over time and, crucially, trying to manage the potential downsides, the risks.
Okay, so that brings us straight to risk and return, doesn't it? The classic balancing act.
Absolutely. The source is clear. Any investment has risk. There's always a chance its value could drop. You could lose money.
But, and this is the key part, I think, the potential for bigger rewards usually means taking on, more risk.
Exactly. It's like driving faster. You might get there quicker, but you need to be way more careful. Higher potential return often equals higher risk.
Which leads right into understanding your own risk tolerance.
Yes. And this isn't about being brave or reckless. It's just about knowing what level of fluctuation you're genuinely comfortable with.
So you don't panic sell at the first dip?
Precisely. Taking on too much risk for you can lead to bad, impulsive decisions. And on the flip side, we measure success with return on investment, ROI. How much profit did you make relative to the investment?
Got it. So we're always trying to get the best ROI we can for the level of risk we're comfortable taking.
That's the goal.
And this all seems tied up with how long you plan to invest for, the time horizon, right?
Definitely. The source really emphasizes this. It's simply the length of time before you think you'll need that money back.
And why is that so important?
Well, time is a huge advantage in investing. A longer time horizon, say decades for retirement, gives your investments more opportunity to grow. Think compounding.
Ah, yes, compounding, where your returns start earning their own returns.
Exactly. It's like a snowball effect. Plus, more time means more chance to ride out the inevitable market bumps, those temporary downturns. Someone saving for a house deposit next year needs a very different strategy than someone investing for 30 years from now.
Makes perfect sense. Okay, so we've got the basics: risk, return, tolerance, time. Now, the source calls something the cornerstone of strategic investing. What's that about?
Right. So if risk is unavoidable, how do you manage it effectively? The answer this source gives is diversification.
Don't put all your eggs in one basket.
That's the core idea, spreading your investments across different types of assets and markets. So if one area tanks, it doesn't sink your whole portfolio.
Okay, that feels intuitive. How do we actually do that? How do we diversify in practice?
The main way is across different asset classes. These are just broad categories of investments that behave differently. The source points out a few key ones. First, equities or stocks.
Shares in companies.
Exactly. Ownership shares. Now, historically, they've offered the highest potential for long-term growth, but they also come with higher volatility. Their prices can swing up and down quite a bit.
Okay, high potential, high bumps potentially. What else?
Then you've got fixed income. Think bonds. These are essentially loans you make to governments or corporations.
So generally safer, maybe?
Generally more stable, yeah. But typically they offer lower returns than stocks. Government bonds are usually seen as very safe, while corporate bonds might pay a bit more interest because there's slightly more risk the company could default.
Got it. Stable, lower return. Next.
Real estate.
Yeah.
This could be owning rental properties directly or investing in things called REITs.
REITs.
Yeah, real estate investment trusts. There are companies that own or finance income-producing real estate. It lets you invest in property without, being a landlord yourself. Real estate offers potential income from rent and the chance the property value goes up.
Okay. What else is in the mix?
Commodities.
Yeah.
Things like gold, silver, oil, agricultural products. Sometimes these can act as a hedge, protection against inflation or economic uncertainty. Gold, for instance, is often seen as a safe haven.
Interesting. And there was one more category.
Yes, a broad one. Alternative investments. This covers things that aren't your typical stocks, bonds, or real estate, like private equity investing in private companies not on the stock market, or venture capital, funding startups, even things like hedge funds, which use complex strategies.
Right. So quite a range there. Okay. So spreading money across these different types of assets is step one for diversification. But the source mentioned going further.
Absolutely. Geographic diversification is key too. Don't just invest in your home country. Putting money into international markets, maybe some emerging economies, gives you access to different growth stories and protects you if your home economy hits a rough patch.
So if the U.S. market is down, maybe Europe or Asia is up, potentially balancing things out.
Exactly. Different economies move at different paces.
And then even within, say, stocks, you can diversify more.
Yes, definitely. Industry and sector diversification. It means not putting all your stock market money into, say, tech companies. Spread it across healthcare, finance, consumer goods, energy, and so on.
Because if one sector hits a wall, the others might still be doing okay.
Precisely. If tech has a bad year, maybe healthcare utilities are holding steady or even growing. It reduces that concentrated risk.
Okay, so diversification is like building resilience into your portfolio. Makes a lot of sense. Now let's get into the specifics of some of these types of investments, starting with stocks or equities.
Right. So investing in individual stocks, or maybe ETFs, exchange-traded funds, which are like baskets of stocks, that's where you often find the potential for higher returns we talked about.
But also higher risk, so better suited for people with a longer time horizon, maybe?
Generally, yes, and a higher tolerance for those ups and downs. Now, within stocks, the source mentions a few main strategies people use. One is value investing.
Finding bargains?
Sort of, yeah. Looking for solid companies whose stock price seems, well, lower than what the company's actually worth. You buy hoping the market will eventually realize its true value. Warren Buffett is probably the most famous value investor.
Okay, finding those undervalued gems. What's another approach?
Growth investing. This is different. Here, you're looking for companies you think are going to grow their earnings or revenue really fast, maybe faster than the overall market.
Even if the stock already looks a bit expensive?
Sometimes, yes. The bet is that their rapid growth will justify the price and lead to big returns. These can be more volatile, though.
Makes sense. And there was a third one.
Dividend investing. This strategy focuses on buying stocks in companies that regularly pay out a portion of their profits to shareholders. Those payments are dividends.
So you get a regular income stream from your stocks.
Exactly. And you can either spend that income or, often more powerfully, reinvest it to buy more shares, which then generate more dividends. It accelerates the compounding effect.
Okay, interesting strategies within stocks. Now, let's shift to bonds, the fixed income side. You said they're about stability and income.
Primarily, yes. They generally won't give you the spectacular growth potential of stocks, but they add a layer of stability to your portfolio. They help smooth out the overall ride.
So good for maybe more conservative investors or people nearing retirement?
Often, yes. People who prioritize preserving their capital or need that predictable income stream. The force breaks down the types. Government bonds, usually the safest, backed by the government.
Like U.S. Treasuries.
Exactly. Then corporate bonds, issued by companies. They usually pay a bit more interest than government bonds to compensate for the slightly higher risk that the company might, struggle to pay it back.
And the last type.
Municipal bonds, or munis. These are issued by state or local governments. A key feature, at least in the U.S., is that the interest income is often tax-free at the federal level and sometimes state and local, too.
Ah, okay. Tax advantages can be appealing. Now, real estate, always a popular topic. How does the source position it for strategic wealth building?
It highlights the dual potential, really. First, capital appreciation, the hope that the property value itself goes up over time. Second, rental income, which can provide steady cash flow if you rent it out.
And you don't have to buy a whole house yourself, right? You mentioned REITs.
Right. Besides direct ownership of rental properties, you can invest through REITs or even real estate crowdfunding platforms now, which let you pool money with others for specific projects.
Are there other benefits mentioned?
Yeah, potential tax advantages are often cited, like deducting mortgage interest and depreciation costs against rental income, which can lower your taxable income.
Okay. And finally, those alternative investments. They sounded a bit more complex.
They can be, yeah. They offer another layer of diversification, potentially uncorrelated with stocks and bonds, and sometimes access to higher returns, but often with more risk, less transparency, and they can be harder to sell quickly, less liquid.
What were the examples again?
Private equity, investing directly in private companies, venture capital funding startups, which is very high risk, high potential reward, cryptocurrencies like Bitcoin, Ethereum digital currencies, very volatile, quite speculative still, and commodities, gold, oil, agriculture, which can sometimes hedge against inflation.
So definitely areas requiring more research and maybe a higher risk tolerance.
For sure. Often for more sophisticated investors or as a smaller part of a diversified portfolio.
Okay, so we've toured the different investment types in stress diversification, but the source says just picking investments isn't enough, right? There are core principles for success.
Absolutely. Building lasting wealth is also about your behavior, your mindset. The first principle mentioned is huge. Start early and stay consistent.
Time in the market.
Beats timing the market, exactly. Compounding works its magic best over long periods. Starting early, even with small amounts, makes a massive difference down the line. And investing regularly, consistently, builds that base steadily.
That makes total sense. What's next?
Focus on long-term goals. You need patience. Strategic investing isn't about getting rich quick. It's about funding retirement, maybe kids' education, financial independence.
Yeah.
You need to stick to your plan and not get spooked or greedy based on short-term market noise.
Easier said than done sometimes with all the news. How do you stay focused?
Well, that ties into the next one. Regularly review and rebalance your portfolio.
What does rebalancing mean exactly?
It means checking your mix of assets, your stocks, bonds, etc., periodically. Because some will grow faster than others. Your original intended mix, say 60% stocks, 40% bonds, might drift to 70-30. Rebalancing just means selling some of the winners and buying more of the laggards to get back to your target allocation.
So it forces you to buy low and sell high in a disciplined way?
Kind of, yeah. It helps manage risk and keeps your portfolio aligned with your goals and comfort level. It's like tuning an
I
instrument.
got it. What about the emotional side? Big factor, right?
Huge. Avoid emotional decision-making. This is critical. Fear and greed drive a lot of bad investment moves. Panic selling when markets drop, or chasing after some hot trend without understanding it, these can destroy wealth. Sticking to your predefined plan is key.
Discipline over emotion. And the final principle.
Leverage professional advice. You don't have to do it all alone. A good financial advisor can help you create a tailored strategy, navigate taxes, plan for retirement or estate issues. They offer an objective viewpoint which can be invaluable, especially when emotions run high.
Okay, that's a lot of ground covered. So if we boil it down, this deep dive suggests building lasting wealth strategically involves, well, first understanding risk and return for yourself. Then embracing diversification across assets, geographies, industries.
Right. And knowing the characteristics of different investment types, from stocks and bonds to real estate and alternatives.
And underpinning it all are those principles. Starting early, staying consistent, focusing long-term, reviewing regularly, keeping emotions in check, and maybe getting some professional help.
Exactly. And the source really ends on an encouraging note. Building lasting wealth is achievable.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.